Thanks to everyone for attending this session. Great honor for me to present my research here. So today I'm going to discuss one of the largest US government intervention in the financial market. Everyone in this crowd knows that banks do not only fund themselves with retail deposits, but 25% of their external funding is borrowed from other financial institutions through wholesale funding. And in the wholesale funding market, the government has been very actively involved and set up many agencies to channel cheaper credit to the banking sector. But there is a debate, which is also my research question in this paper, whether this type of government intervention is beneficial to bank lending. There is no consensus in the literature, and most of the previous studies has been focusing on banks' risk-taking behaviors and liquidity transformation. So in this paper, I provide a different perspective and contribute to the literature by focusing on the effect through changing banks' market structure. In my empirical analysis, I explore the largest government-sponsored funding program, the Federal Home Loan Bank, which allow its member banks to access low-cost wholesale funding with mortgages as collaterals. In particular, I ask, how does the Federal Home Loan Bank affect its member banks' mortgage origination? And how does it affect the local mortgage market in general? But what is so special about this Federal Home Loan Bank? First, the funding from the Federal Home Loan Bank is very cheap. The rate of Federal Home Loan Bank advances is close to the Treasury yield. Second, different from many other private wholesale funding providers, the Federal Home Loan Bank charges the same interest rate for all its members, regardless of their size. So for many small banks, this is the only source of wholesale funding at such a low cost. And to access Federal Home Bank funding, a bank has to become a member by application and buying Federal Home Bank stocks. So the empirical challenge in this paper is that joining Federal Home Bank is an endogenous decision. So we cannot simply compare member banks and non-member banks to get a causal estimate of the Federal Home Bank effect. Instead, I use bank mergers to generate exogenous enrollment into Federal Home Bank membership. The idea is that if a non-member bank was acquired by a member bank, the target branches will have access to Federal Home Bank funding after the merger. But only that is not enough because two things happen at the same time. Federal Home Bank funding access change and the merger itself, which might have many other effects. So to solve this problem, I consider multiple target mergers where a bank simultaneously acquire multiple target banks, and some of them used to be members, some of them used not to be. And I'm going to use the within merger difference to differentiate out the merger effect. So in the period from 1994 to 2016, I collect a sample with 174 multiple target mergers, which involves about 500 target banks. So this is an example. So the blue dots on this map are Illinois National Bank, which was operating in the urban areas of Springfield. In the year of 2003, it acquired two banks, Triangle and Cross, to expand to the suburban areas. The Cross Bank was not a Federal Home Bank before the merger, so it is the treated bank. And the Triangle Bank had been a member before, which serves as a control. So I'm going to use the difference between the Cross and Triangle Bank to causally estimate the Federal Home Bank effect. Now let's look at the results and see how individual banks are reacting to Federal Home Bank funding access with this identification strategy. So first, if we look at the mortgage interest rate, on this graph we can see that banks will reduce their mortgage rate after getting access to the Federal Home Bank advances. And the effect persists over many years. And the average drop of mortgage rate is around 18 basis points. Second, the effect on mortgage origination volume is even more significant. Banks will issue 16% more mortgages after joining the Federal Home Loan Bank. And third, I look at the profile of the mortgage borrowers. Here, I focus on 3 dimensions: interest rate type, FICO scores, and loan-to-value ratios. We can see that banks issue mortgages to borrow with very similar FICO scores and loan-to-value ratios after joining the Federal Home Loan Bank. This is indicating that they are not taking more risk, at least at the micro level, after getting access to Federal Home Loan Bank funding. The only striking difference is at the top of this graph. The banks start to issue more fixed-rate mortgages after joining Federal Home Loan Bank. Why is that? Different from retail deposits, banks can directly borrow fixed-rate funding from the Federal Home Loan Bank to fund their fixed-rate mortgages. So in this way, banks do not have to worry about the interest rate risk, so they are more willing to issue fixed-rate mortgages after getting access to the Federal Home Loan Bank funding. Finally, I look at how banks of different sizes react to the Federal Home Loan Bank funding differently. Here, I break the sample into 2 groups: regional banks with total assets above $1 billion, and community banks with total assets below $1 billion. We can see like the difference between row 2 and row 3, that the community banks react much more strongly to the funding access change than the regional banks, both in terms of the lending volume and mortgage interest rate. Now we know that individual banks will benefit a lot from the Federal Home Loan Bank funding. Then how will that affect the local mortgage market? In my empirical exercises, I focus on a very small market unit, the census tract. So in the next few slides, I'm going to show you how the colored census tracts are performing differently after the merger. First, I found that after the treated banks became stronger due to better funding access, the local market is becoming less concentrated in later years. The Herfindahl index drops by 1.5 percentage points. As a result, the competing banks also reduced their interest rate after the merger, as we can see in column 3. This is due to the increased market competition. Specifically, this is mainly driven by the competing small banks in the same areas, as shown in column 5, while the big national banks are not really responsive to the change of local competition, as shown in column 4. So therefore, the market level interest rate will fall by about 8 basis points. In terms of mortgage lending, the market level mortgage lending will rise by 5%. So this is the first spillover effect through market competition. The second spillover effect I found is on pricing efficiency. First, I found that small banks are more responsive to local economic conditions. To show this, I grouped the banks into 3 categories according to their size: Big 4 national banks, regional banks with assets about $1 billion, and community banks with assets below $1 billion. For each group, I plot their residualized mortgage interest rate against the borrower's default rate in the past 2 years. So in this graph, the y-axis is the mortgage interest rate after taking out all the borrower level risk factors like credit scores and loan-to-value ratios. And the x-axis is to proxy for the local market risk. The orange line in this graph is the pricing curve for the Big 4 national banks. And we can see the Big 4 national banks tend to apply a uniform pricing strategy across the whole nation, while the regional banks, as in this blue line, and community banks in these black lines are more responsive to local economic shocks. So this is consistent with the intuition that small banks are better at information acquisition in their local community. So if we live in a world without community banks, there would be cross-subsidization from low default areas to high default areas due to national banks' uniform pricing. And this would lead to some efficiency loss. Now, we know that the Federal Home Loan Bank increases the market share of regional banks and the community banks by relaxing their financial constraints. So we can expect it will push the whole market to be more responsive to local economic conditions. To quantify this effect, I built a structural model of mortgage lending. And the simulation indicates that the Federal Home Loan Bank will push the pricing curve steeper than a counterfactual without Federal Home Loan Bank. And this new equilibrium is closer to the optimal pricing with perfect information. As a result, the Federal Home Loan Bank will make the mortgages more efficiently allocated and the aggregate default rate drop by 1 basis point. To conclude, I found that the government-sponsored wholesale funding provided by the Federal Home Loan Bank passes cheaper funding to the mortgage borrowers. More than that, the Federal Home Loan Bank has some spillover effect. It increases market competition by making small banks more competitive. This pro-competition effect lowers the markup charged by the big banks and further increases the mortgage rate pass-through. This is all I have today. Thank you. Thank you all.